All right, everybody, welcome back. We have a delicious Hot Topics episode this week. I'm joined by Larry Pershing from Optimum Retirement Planning. Hey, Larry.
Hey, Andy. Glad to be back here. Thanks so much for having me back on. Really excited for today's podcast. And dude, I gotta say, your cheesy bits or your goofy gratitude it's really touching, man. You have this special ability to make me tear up in one instance and then blow my mind with tax planning topics all in the same episode. So I'm really enjoying it. Thanks for sharing that all with us.
Nothing about the dad jokes, though? I'm a triple threat. It's not just big goofy smiles. It's big goofy smiles, tax planning, and dad jokes.
Well, maybe you're a double threat.
All right, yeah, well, with that in mind, just true story, this morning, I stepped outside and a police officer came running down the street. He's like, hey, I'm looking for a guy with one eye. So I said, you probably have a better chance finding him if you use both eyes. You know?
Oh.
And then he handcuffed me and put me, Anyway. Okay, so the dad jokes may be the weakest of the three, so fine, I'll take it. I'm a double threat, not a triple threat. Appreciate it. For those who don't know or didn't listen, I'll link to it, but Larry was on the show. We did a retirement planner chat at some point in early 2024. Great episode, so go back and check that out for those who don't already know Larry. Excellent dude. I've known him for a few years. He has his own firm, Optimum Retirement Planning, based out of Illinois. And we are kindred spirits in the way we approach things and think about things and philosophies on all this. So I'm looking forward to today's Hot Topics chat, Larry.
Likewise, Andy.
Cool. And speaking of Hot Pockets, this just reminded me, when I was in college, living on a budget, Hot Pockets, right? The microwave things that...
Oh, yeah.
So I used to really like the ham and cheese ones, and there was like a 12-pack at the supermarket I went to, so I get those, and I lived on those for a while. And I had one a few months ago. I used to love them in college. Now I'm like, I don't know what I ever saw in them. They're absolutely disgusting. But not only were they like nuclear reactive hot and would undoubtedly scorch the top of my mouth, but it's not even like high quality cheese or ham. To the extent ham could be high quality, it's not. So I don't know. Maybe it's growing taste buds. Maybe I don't know what it is. But just thinking back, Hot Topics reminds me of Hot Pockets. Reminds me of college. Reminds me of I don't know what I ever saw in those things.
Chicken bakes from Costco. Did you ever upgrade to the chick? Like I did Hot Pockets, and then Costco got chicken bakes, which were basically like their take on Hot Pockets, but they were, Costco twice the size, same price or half the price, whatever it is. Right. And haven't had a chicken bake in probably 10 or so years. But same fond memories.
Well, you don't. You probably be let down as I don't know what I ever saw in these things at the time. So let the memory stay. All right. Let's get into Hot Topics. So Larry and I each came up with 4 things that we thought would be interesting to talk about. Some are timely and relevant. Others are just questions we've come across from clients or other folks, or just things we thought would be relevant to talk about. They might be timeless, if you will. First one is the big, beautiful tax bill. I don't know, Larry, let's just kind of start with that and keep it as unpolitical or apolitical as possible, but can you just sort of sum up briefly what this is, why it might matter to people, and we'll go from there.
Wait, Andy, you told me your viewers wanted to listen to my political beliefs for the next 30 minutes. That's not this podcast?
Maybe not. We'll do that on a second episode.
Okay.
Yeah,
third time's the charm.
Correct, yes.
But I'm back for the third time. Okay, yeah. All jokes aside, we got a tax bill now. This is pending legislation, right? So it's not official, but there are some big changes, and I think some action items for folks to take away from this. So I thought it might be helpful to talk about, even though it hasn't been officially put into law, and it'll probably get tweaked from here, and we don't know what that is yet at this moment in early June, but still some things that people may want to take into account. So first off, for tax planning wise, they are permanently extending the current tax bracket. So, 10, 12, 22, 24, 32, 35, 37, those are staying. Now, of course, permanent is never actually permanent because future Congress can always come and change it, right? But we were kind of under the gun here because before they talked about this tax legislation, tax rates were going to revert to the Tax Cuts and Jobs Act pre-2017 rates, which was like 25, 28, et cetera, et cetera. So they're a little bit higher, essentially. So that's good news. Permanent extension there. Any thoughts you want to share on that, Andy?
No, agreed. Like you said, all this stuff, the tax code is written in pencil. It's permanent until some other, congressional, what do you call it? Congressional seating or whatever, until Congress decides to change it at some point down the road. But yes, as it stands now, if there's not any changes, the current generationally low federal tax rates we have will expire at the end of 2025 and revert back to higher ones in 2026. So this would extend the current lower tax cuts, in theory, permanently, again, until it's eventually changed some point down the road. So yeah, good thoughts.
Yep. And so I think this is good for at least, well, really all of our clients who are worried about higher taxes. You can say, hey, for probably won't be changed for a couple years. So we probably got a couple more years at least of this. But Congress always surprises. So we'll see. A couple of things I wanted to point out, even though it could be subject to change, obviously, is we've got a higher standard deduction that would go into effect this year, Andy. So usually with a lot of these tax code changes, say, hey, like beginning next year, we're going to change things. But standard deduction, they said, no, we're actually going to increase it for 2025 if the tax legislation goes into effect this year. And so the way that works is, well, first off, standard deduction, just taking a step back for the listeners or viewers here, it's essentially an amount of, I like to call it tax-free income you get. So the government says, hey, if you're single right now, $15,000 of income you earn, tax-free, don't have to pay any taxes on it. Great. If you're married, double that, $30,000. So what they're changing is now we're going to call this the normal standard deduction, because they made this really complicated. Normal standard deduction is increasing by $1,000 per person. So you're single right now, it's $15,000 this year, you get an extra $1,000 tax-free of income. So you go to $16,000, married couples, $32,000. Then if you're blind or age 65 or better, you get $2,000 if you're single, or an additional $1,600 per person if you're married, so $3,200. And this stacks on top of this $15,000 or $30,000 standard deduction you have. They didn't change that additional for 65 or better, or if you're blind, but they've added a third layer to the standard deduction. But I said, hey, a bonus standard deduction, we'll call it. Each person would get $4,000 of additional tax-free income. So unless you're doing the math in your head, I'm going to do it for you. So right now, let's say you are a married couple and you're both age 65 or older, okay? Your standard deduction would be $33,200 this year, okay? $33,200 this year. You're both age 65 or better. With the standard deduction change, what they're proposing is that instead, it's going to be $43,200 of tax-free income. So you get an additional, what is that? Like $10,000 each. $10,000 for a married couple of tax-free income. So that's nice, but there's a catch with this, Andy. So it sounds like great, extra $10,000 tax-free income. This is great. It's subject to a phase out. Of course, our favorite friend, Maggie, or Magi. I don't know how you pronounce it. Jedi? Magi? Jedi?
I say Maggie. Yeah, I'm sticking with
Maggie.
it.
And I actually didn't look and see what Maggie it is. So I don't know if they're using existing or they're going to throw a fun new one at us. But for a single individual, it starts phasing out at $75,000 of Maggie. For a joint individual, we're at $150,000. And it goes away after $100,000 of income. So why I think this is important to bring up is hey, one, if we're thinking about accelerating our income in retirement, which we do a lot with Roth conversions, where, hey, we want to realize capital gains income. Let's just take a married couple, for example, have $150,000 of income. All of a sudden, you increase your income to $250,000 of income. Maybe you think you're in the 22% tax bracket, 24%, you want to lock that in with a Roth conversion. Well, now you just lost out on the bonus standard deduction amount that will go away. So the additional $4,000 per person, $8,000 married couple, you lose if you do that. And so the way that works out is it's for a single individual, it's about a 1% additional tax increase. And for a married couple, it's about a 2%. It's a little less than that. I think it's like 0.88 or something when I was doing the math. But suffice it to say, this kind of turns part of the 22% tax bracket into the 24% tax bracket for a lot of folks. If you're thinking about doing conversions or accelerating income, and this would go into effect this year. So if you're doing 22%, you might be fine with saying, hey, I'll just pay 24%. It's not that big of a deal. But I thought always better to at least know this is out there and could impact you this year with your tax decisions. Not even next year, but this year. I just blabbered on about that. Andy, you want to clarify that for anybody, or did I make that? Was that clear as mud? Or?
Yeah, I'll clarify. You did indeed blabber on, if that's what you, no, just kidding. I thought that was great thoughts, great analysis. It's frustrating that this provision would be in effect this year. Now, this can all change. This has passed the House. It still needs to go to the Senate. We're halfway through the year. Who knows if and when this gets finalized or what changes between now and then. My concern is this is something that, like, last minute, mid-December goes into effect. And it's like we're all going to be in a pinch to plan accordingly and revise income plans and projections and tax amounts and whatever. So I'm hoping whatever happens with this gets squared away sooner rather than later and codified into law sooner rather than later. But yeah, that is an interesting dynamic where this additional standard deduction starts to get phased out at certain income levels, which definitely complicates the analysis for this year. Bigger picture, we all knew, well, we think we know that given the political balance of power, that the Tax Cuts and Jobs Act would be extended in some form or fashion, right? We didn't know what would be extended, what would be kept, whatever. This big, beautiful tax bill, which is might actually be the formal name of it, I think, right?
I think it is, yeah. We had Build Back Better, we had Triple B, and we got another Triple B. So I don't know what it is about the Triple B acronym, but the politicians like it.
I like it. They like alliteration, I think is the term for that. A lot of the other stuff in there, I just have quickly I brought up from the taxfoundation.org. It's one of my go-to places for not just tax information, but also tax analysis. They're really good at, in my opinion, as politically agnostic as someone can be. They really focus on what's the potential growth impacts, revenue impacts, deficit impacts, et cetera. Now, all this stuff, I always take with a grain of salt. Like the Congressional Budget Office says this bill is expected to reduce the deficit by this much or increase by this much. Like, who knows? I guess these are all better than just saying we have no idea, but these are all just estimates. Anyway, for people listening and watching, some of the other things to know, like you already said, the existing tax brackets will live on, in theory, permanently. A little more standard deduction with some phase-outs. The SALT deduction, state and local taxes, which was a big one, especially depending on the state you're in, caps your itemizable deductions, specifically those relating to state and local taxes. So state income tax, property tax on your house, $10,000 max cap. Now, in high property tax states, high income tax states like New Jersey, New York, Massachusetts, California, this has been a big deal.
Illinois.
Because in New Jersey, where I live, highest property tax state in the country, the median property tax is like $12,000 or something like that. So you can easily get well beyond $10,000 of state and local taxes. The beautiful big bill or whatever is talking about raising that up to $40,000 state and local tax cap with some phase outs on income again that would reduce it. So it could get messy, but this is something that could potentially impact people. What else? I'm just looking here. There's some child tax credits that would get extended and temporarily increased. It looks like, maybe, if I'm reading this correctly. The alternative minimum tax would basically be a non-issue for everyone. Most people going forward. Very few people get sucked into that now, which is nice. Before Tax Cuts and Jobs Act, a lot of people did get caught up in this, and it was just a mess from a tax preparer perspective. Some changes around the way tips, tips you get from working jobs, the taxability or lack thereof of that.
Not the investment, right, Andy?
Not the Treasury inflation protected securities. No, not those. Tips like, hey, you're a waiter and you get paid in tips. That would, looks like, be temporarily non-taxable if I'm reading this bulleted summary right. And some phasing out of other stuff like energy. This is more politically driven, but getting rid of like electric vehicle tax credits and home energy improvement tax credits. Those are on the chopping block with this big, beautiful bill. So
And I think those will last through 2025 though. So like the electric car deduction, I think the green like home improvements, I think you still get that through this year, but then they go away moving forward. Of course, all subject to change.
Yeah, exactly.
But so it might be like, if you're on the fence about doing these things, 2025 would be potentially the year, because it might be on the chopping block. And going back to tips, Andy, hey, we're business owners. Can we work for tips now?
We can take, actually, I don't know about that. That's interesting. I know you're joking, but that's an interesting question. If someone wanted to give us a tip, how do we do that?
Well, so the IRS said, though, for business owners, if you're a specified service business or, that QBI deduction lingo, no dice, not allowed.
Oh, interesting. Okay.
Yeah, not
so we
allowed
can get tips, but we'd have to report it.
Yeah, it's going to give us no tax benefit, essentially.
Okay.
And I think they said even it's like only industries that historically have received tips or wages or professions. So they're like, not everybody can change to, hey, can I get, I'm a W-2 employee, I'm working for, some company. Can they just tip me now instead of salary? That's not gonna fly.
Won't fly, man.
And I think they might still be subject to payroll taxes too. So not 100%.
Okay.
Tax free.
Not truly tax free. Yeah.
Either, but I know another thing, Andy, I wanted to bring up that it's actually not in the BBB. Is they're not extending the ACA enhanced premium tax credits. And so for folks who are thinking about retiring early or already are on the ACA, also known as Obamacare, public health insurance exchange, big changes coming to that. So assuming, and this doesn't seem like a big political priority, so I would be surprised if this got added back, and it's probably safe to say it's not going to be in the bill. And so what that means is beginning in 2026, the cliff is coming back for your premium tax credits on the health insurance exchange. So usually how this works is, hey, depending on your income level, the government might help subsidize your health insurance premiums. And essentially the way they do it is you tell them your income, they say, okay, we'll subsidize your premium $500 a month. But then come your tax return, they're going to true it up, right, Andy? They're going to look back in your tax return and say, this is how much you actually made, this is how much you're owed. So with these enhanced premium tax credits that went into effect, I believe in 2022, it was a nice level phase out. So basically, keep it really high level. As your income increased, you lost some premium tax credit subsidies. But now, beginning in 2026, it looks like, hey, if you go $1 over this income limit, you're going to have to pay back all of the premium tax credits you received. And so if for example, let's just make up a number here. Let's say it's $80,000. If you're like, oh, my income's going to be $78,000, great. You're due, $5,000 of this premium subsidies for your health insurance, and then accidentally you have an extra couple $1,000s of income. You go over that $80,000 threshold. Boom, you got to pay back all $5,000 you received from the year on your tax return. So it's not fun, and it's going to make it harder to plan for our early retirees to take advantage of that, if that's possible for them. And they're also getting rid of the recapture limits. So if you, I don't want to get too in the weeds on this, but essentially if you were getting premium tax credit subsidies, sometimes they'd say, hey, based on your income, you owe us this amount, but we're going to cap how much you actually owe. And they're doing away with that and just saying whatever you should owe based on your income, that's what it's going to be. So it's going to make it harder to get those in the future for folks, essentially.
Well, and in case anyone's interested, I don't know the exact amounts, but when it reverts back in 2026, where there's this hard cliff Larry's talking about, it's 4 times the federal poverty level is where that cliff is. Now, the federal poverty level differs whether you are in the 48 lower states or Hawaii and Alaska have their own higher limits. The last I checked, and it's probably a year ago, I want to say for a single household, it was like $15,000 a year is a federal poverty level in the lower 48. It was a few thousand extra for the other two. a household of two was slightly higher. It wasn't double, but it was slightly higher than 15 grand, if I remember correctly.
I think it was around like 20, if I'm remembering.
It could be. Feels about right. Yeah.
Like it wasn't even close to double.
No, it definitely wasn't. So if you're 4 times that, so if you're single, let's just assume it's 15 grand, just to keep the math even. That would mean only $60,000 of gross income is the max gross income you can have before you're off the cliff. Like you're not eligible for any premium tax credits at that point. So it's going to make it a lot harder because now, like you said, there's this gradual phase out where you don't just like get something to nothing. You slowly kind of wind your way down to getting no credits the higher up your income goes. This will be challenging. And I'm guessing because this was a Obama era thing that Biden extended during COVID with making this gradual thing or kind of lessen the impact of the cliff with this gradual thing. I'm guessing there's not a lot of motivation to want to keep this in the big, beautiful bill. So to your point, I didn't bring it up. I'm glad you did. What's as important as what's in the bill is what's not in the bill, and this is one of the things. So suspect this goes away at the end of 2025 as things stand now, but anything can change. So,
and Andy, one question I always get from people is there ever a time where I want to take money out of my Roth IRA before I die, essentially, or like it's the last remaining source of funding I have? And I think this could be one of those situations where if you know you're going to be close to that cliff, that could be the time where, hey, maybe it makes sense actually to pull money out of your Roth IRA to preserve your premium tax credits. But agree with me, disagree?
Yeah. And not just that, but in general, a Roth is a great, if you're trying to get really tight and cute with your income planning, for whatever the reasons are, whether it's to avoid this cliff or to not go over Irma or to whatever, Roth IRA money, that's exactly what you want to use it for in cases like that, where like there's not really any other sources of cash flow. Let's say you need additional cash flow and you're already maxed out on your gross income for whatever your plan is. Roth IRA, I think that's a good use for it. So great point there. It's not just like, oh, let's just save it for later. One day later comes. And even along the way, between now and later, whenever later is in your plan, this is a really good tactical use of getting additional cash while not having any impact to your tax return and juicing up gross income at all. So great point.
I love that you brought up Irma as well too, because that's another great use for it, where you're close to that pesky Irma threshold, but you want to buy a car or whatever it is, you need the money, and you want to pay a couple extra $1,000. Great use of it. So good point, Andy.
Yep. One other comment that's can affect some people is the estate size exemption, which is currently about $14 million, is due to get halved in 2026 if the Tax Cuts and Jobs Act is allowed to expire. This new bill would increase it to $15 million starting in 2026 and index it for inflation every year going forward. So $15 million per person. So married couple would be like $30 million that you can gift away during life and or transfer upon your passing to your heirs without there being any federal gift or estate tax on it. Now, state level may be different. Like Oregon's got a goofy small $1 million estate size where if you go $1 over that, Oregon imposes an estate tax on you. Massachusetts isn't far behind at $2 million, I think, but federally at least, it would be $15 million per person, which is quite chunky. So vast majority of people will not be subject to federal gift or estate tax.
Yeah, it's really those state estate taxes. Illinois is $4 million, being an Illinois resident. So yeah, it's really those state estate taxes that can get you. I think one last thing I want to bring up from this is HSA contributions can potentially be doubled. They're potentially doubling the amount you can contribute to your HSA in the bill. But again, depending on your income, it phases out again. Maggie, our good friend Maggie, for same as the standard deduction we talked about earlier, single individual, once your income starts going over $75,000, you start losing this bonus HSA contribution. So right now you can contribute $4,300, I believe, for 2025 into an HSA as a single individual. So then it doubles to $8,600. But if your income's over $75,000, then you start to lose that ability, and eventually you'll hit, if you have enough income, you'll be back to $4,300. Married folks, it's $150,000 of income. You start to lose the ability to contribute to an HSA. And so again, if you're one of those people, actually, I guess it doesn't matter because this goes into effect in 2026. But for tax planning going forward, that could be another complex thing where one spouse is retired, one spouse is working. You think, hey, I'm in the 22% tax bracket. I want to lock that in with a Roth conversion. Then, oh, oops, I'm actually losing the ability to contribute $8,000 into an HSA. That's a big, that's a stealth tax is what I like to call them. It's not going to show up on the tax brackets, but it certainly impacts your tax situation. So again, we'll have to see with it. One thing they did make, though, that was easier with this was like always a super confusing thing to deal with clients is if you begin Medicare Part A, then you are still eligible to contribute to an HSA. So that's not Part B, though. So real quick for folks, if you go on Medicare Part A, usually you cannot contribute to an HSA. But the tax bill is saying, hey, we're going to do away with that. You can go on Medicare Part A, still contribute to an HSA. Now, once you begin on Medicare Part B or you go Medicare Advantage, then you lose your HSA eligibility. But for a lot of folks, what would happen is somebody wants to take Social Security. When you take Social Security, you're automatically enrolled in Medicare Part A, and then usually you lose the ability to make the HSA contribution. Now they're going to change that so that little wrinkle there isn't there for you anymore.
I didn't know that. You clearly dug much deeper into this than I did, but that's really good. I'm glad to see them do that. Hopefully that sticks, because that's a really annoying stealthy gotcha that a lot of people don't know about.
And another thing they did to simplify it is, for folks 55 and better, you can make the additional $1,000 catch-up contribution to your HSA. Yeah. But if you're the spouse that is not the primary insurance holder on the insurance plan, you have to go open up your own HSA and make that $1,000 contribution, right? So the spouse who has the health insurance in their name, they're the one working. You got a retired spouse. The one who's working, health insurance in their name, they can contribute $8,300 plus an additional $1,000 catch-up contribution. I think is it $8,350? It might be $8,350, but anyways, around there. Andy's got his handy dandy tax sheet.
Getting my laminated, printed out tax sheet and go to the HSA section. I always gotta take a look and see where this is again. You can keep talking. Oh, here we go. Single person, 4,300. Family coverage, 8,550.
8,550?
8,550, yeah.
8,500. Oh, okay, perfect. Yeah, thanks for correcting me, Andy. So 8,550 for a married individual. So then you get the $1,000 catch-up. You can do $9,550 in your HSA, but then your spouse, they're age 55 as well. They can do a $1,000 catch-up contribution, but it can't go into the HSA account of the person who actually has the health insurance who's employed. The retired spouse, they can make a $1,000 contribution. They're on the plan, but they have to open up their own HSA account. They're going to nix that rule and just say that $1,000 contribution from the retired spouse can go into the married spouse's HSA.
Good. Okay.
So that also just alleviates some complexity right there, because HSAs are so simple, right, Andy?
Yeah, the easiest. That's nice that they're doing that, actually. That's like the Part A thing you talked about, and then not having the other spouse to have their own HSA. That's good, because those don't really add any practical value or benefit to have those current things in place. They just make it a headache. So the fact that they get rid of it would be nice. So I hope those stick around.
Yep. All right. Well, we've talked a lot about BBB, Andy.
Yeah.
Anything else you want to touch on?
No, I think we're good for the BBB. Like you said, this is all just pending. It passed the House, still needs to go to the Senate. To be determined what finally sticks in here and when, but I think a lot of this is likely to stick around. Now that this has been out there, it's passed the House at least, expect a lot of the things we just touched on to stay in the final bill. Which particular things, I don't know, but I think this is a good indication of what to expect at the end of this year, going into 2026.
And another thing, Andy, even if it doesn't make it in the final bill, sometimes it's nice to know what they're thinking, because oftentimes they bring it back in the future. And so even if hey, this time it didn't work, but next time, now you kind of know what they're angling for, and what could potentially change the tax code in the future.
Yeah.
They haven't talked about getting rid of backdoor Roth contributions, right? So that's...
No. And I think I don't know who, but someone that I thought was trustworthy, knows about tax legislation, is a lot of times when people propose bills, they'll just float stuff out there. Not all of it's going to stick, and they know that, but some of it can just be to get other constituents and policymakers and the public's temperature on it, if everyone universally slams a particular provision, like it's gone, it's never coming back. But once they float it out there and it gets some traction, it's like, oh, this might be something that could resurface at some point in time, if not this bill, some future bill. So that's a great point. We know what's on people's minds, at least current political power in office. Some of this stuff could resurface at some point if it doesn't make it into the bill this year. Okay. Excellent. Another hot topic, timely. I'll let you start this one off, but I've had clients ask the same as you have. Concerns about U.S. Treasuries, potential of U.S. default, the debt level, especially with the new BBB, and estimates widely seem to think this isn't going to help the deficit long term. It's likely to only make it larger. What do you tell people? Like, when should we be concerned about the U.S. and level of debt? And if so, what do we do about it?
So I'm hearing two questions there. One, it's do we want to change our holding of U.S. Treasury bonds because of the deficit? And two, should we be worried about the deficit? So one, let's just tackle, I think, the Treasury bond question, because I think that's a little easier. Like, should this, because obviously deficits are there. We'll talk about if they're an issue in a second, but should we change our holdings of U.S. Treasury bonds? Well, I think we need to think about, why are we actually holding U.S. Treasury bonds, right? And at least for me and my clients, I mean, disclosure, we have U.S. Treasury bonds, individual and in bond funds. Not investment advice here for your individual situation. You guys know the disclaimer, but we hold these because we want to make sure that the money is there. This is our safety blanket, our help sleep at night money. This is our war chest of when the stock market drops, and that's a when, not if. You know, we know if we're invested in stocks long enough, it's going to drop. Well, does that mean you have to cut your spending vacation or take a pay cut? Or, well, if you have money in U.S. Treasury bonds, U.S. government's never defaulted on its debt. There's a 99% chance you're going to be safe, good to go. This is essentially the safest investment, in my opinion, in the world still, even with the deficit. We'll talk about that in a second. And because that's our safety money, I don't see a reason to, all of a sudden sell off Treasury and say, oh man, these are too risky now. And where else are you going to go? I mean, it's hard. We can talk about this, but I think if the U.S. government is defaulting on its debt, you don't want to be invested in corporate bonds, because there will be some ramifications to corporate debt as well. And foreign countries will also be impacted by a U.S. Treasury default. So basically, if that happens, everything's going down. So you might as well hold the safest investment in the world. Shouldn't worry about this. Your sleep at night money, and it's there for that money you really need and want. At least that's how we use it at my firm. In terms of the deficit, I mean, I think this is actually a legitimate concern. The question is, what do we do about it? So right now, to give some numbers, for the U.S. government's last fiscal year ended in, I think, September 2024, U.S. government spent about $1.8 trillion more than it brought in. Okay, and then two, we have to remember Social Security and Medicare are projected to eventually, quote unquote, run out of money. Doesn't mean they're going to zero. It just means they would have to take some benefit cuts to keep the benefits flowing. So they can't pay 100% of benefits. They might only be able to pay 90%, really, kind of for Medicare, the hospital fund, and Social Security is around 75%. But so if you kind of take into account those annual deficits, that's like another less than 400 billion, around there. So if we had 400 billion Social Security, Medicare, plus 1.8 trillion in deficits of the U.S. government that it's just spending, we get about 2.2 trillion that the government's spending more than it's bringing in. Probably not sustainable, but remember, that's kind of the cost, right? What's the benefit of that deficit spending? One, it's going into the economy, it's fueling growth, right? So you're going to get some benefit from that. But two, the U.S. economy is $29 trillion roughly. I think that was at the end of 2024. So we're spending $2 trillion more than we're bringing in, but our economy is valued at $29 trillion. So these are really, really big numbers. But to put it in perspective, that's a deficit of 5-6%, which can't go on forever. But I think sometimes people hear like, oh, 2 trillion, 1.8 trillion, like that's an insane amount of money everything, we're never going to get out from under this. But remember, the U.S. economy is ginormous. I mean, 29 trillion is a big number. 2 trillion is a big number. 29 trillion even bigger. So I think, I guess I'm beating around the bush here a little bit, but I think that we know that these deficits are not sustainable. We can't keep on doing 2 trillion indefinitely into the future, especially as kind of a size of the economy. But when does it actually matter? And that's the answer. Nobody knows.
Yeah.
To give you an idea, Japan, their government debt is twice the size of their economy. So our government debt is about roughly equal. Our total government debt about 29 trillion. Our economy size 29 trillion. So we're about 1 times. Japan's it's double, and Japan does not have inflation issues. They have the opposite issue. Now, we're not Japan. There's a lot of differences, but still, it kind of goes to show you an advanced, highly skilled economy. They have a lot more debt than we do, and they're not dealing with inflation or their government bonds. There's a fleet of safety with the yen right now. The U.S. dollar has declined against the yen this year, and they've got a lot more debt than we do. So these questions are difficult, and I think ultimately it comes down to, do you have a good financial plan in place? What's your plan? But if you are worried about this is where, hey, maybe you don't want to buy 30-year Treasury bonds or really go out really long with Treasury bonds, because those are the ones that are going to get hammered if the deficit becomes unsustainable, we have higher inflation, interest rates rise. You're going to see the biggest impact to the longer dated investment options. And of course, if you're worried about inflation, you have tips, the actual investment, Treasury inflation protected bonds, that can be helpful to alleviate that. Not that you should do that specifically, just in general, that's kind of investment education 101. So Andy, what are your thoughts on the deficit? Do you lose sleep over this?
I don't. Similar to what you said and feel, it's like the deficit doesn't matter until it does. And it's the until it does that we don't know what exactly is going to be the impetus or bright line test. This is, okay, now it matters. I would recommend everyone, there's a really good book called The Deficit Myth, written by Stephanie Kelton, I believe. And she was an economist for one of the presidential administrations. I don't remember which one. Really, and you may not agree with her. She clearly has her political views kind of align one way versus the other, and that will turn people off. But strip that out and just look at the example she gives and the explanation she gives about the deficit and how the U.S. government, specifically a government that has its own currency, as we do, a country has its own currency and can print its own currency, it's very different than a household. So a lot of people will say, think about a household where it's spending more than it brings in and it's taking on debt. It has to pay the debt off. Something has to give. This does not work. It's very different. You may not understand it. I'm not going to do a good job explaining it, unfortunately, but the book explains it in a lot of really plain English, very sensical examples and explanations about how you can't view it that way. We have the ability to just simply print more money. Now, people are going to say, well, you can't print money indefinitely. It leads to inflation, and that's the point of the book. The deficit doesn't matter until inflation tells you it matters. Inflation is a market saying, you're just printing money for the sake of printing money. We don't want to buy it anymore. It's going to be worthless because you just crank out more of it. That hasn't happened. Now, granted, she wrote the book before 2022, when inflation was very well controlled, almost too low for a prolonged period. And she's like, look, we have a deficit. Inflation's been 2% or below for a while. Clearly, deficit's not an issue. Otherwise, the market would signal it is by raising inflation. 2022 happened. Inflation shot up to 8 or 9%, but quickly, relatively quickly, came back down. Now it's bumping around 3%, back more toward a normal-ish level of inflation. So using what she said in the book as an example, like the market, as measured by inflation, still isn't saying the deficit is a problem. Again, I don't know when it is a problem, but like to your point, Japan has double the gap we have of debt versus GDP or national output, and they have too low of inflation, if anything. So like deficit works for them. They're in the same position as us in that they have their own currency. They can issue their own currency just like we can. They've clearly printed a lot of debt, but it's okay. So again, we're not Japan, like you said. So I don't know. I do feel like I get what she's saying. I understand you can't think about the U.S. government as a household budget, 100% sensical. But I also feel like, well, like to your point, this just can't go on forever. this increasing deficit. But I don't know when and if it's going to be a problem. And if it ever is a problem to the point that people stop buying U.S. debt because they're that concerned about us, interest rates will shoot up to try to make debt more attractive. Then you get caught in this bad trap quickly. But if the U.S. government ever were to default such that it can't pay its debt obligations in full and on time, the world is in a much, much worse place overall than us and our Treasury bonds. Like you said, corporations, the credit's going to be shot. If the U.S. is in that dire straits economically, what other country is going to be in a better position? Like, what's the better alternative at that point? I don't know if there is one. So,
Switzerland, maybe,
possibly.
But I think the Swiss debt is like 0%. So the market recognizes it's safe, so you don't get anything.
So I don't know what the answer is. And I had a couple clients ask me this, and I basically said the same thing. Like, I can start to see a case now where I can argue there is more reason to be concerned about the U.S. and its debt position because of enemies we're making now with long-standing relationships throughout the rest of the world. And try not to be political, but you get too America first, and you're going to turn off partners who want to invest in the U.S., who want to buy and hold U.S. debt. The more the demand dries up for U.S. debt, U.S. treasuries, the higher the interest rate will be, and it becomes a self-fulfilling prophecy of the deficit's going to spiral because the interest cost on the debt gets larger. We're going to have to refinance that by churning out more debt, and then you can get into this really bad trap. I still think we're far from the point where, oh my God, we got to run and everyone be concerned, but I can start to see now, whereas up until a few months ago, I wasn't really concerned at all with the deficit. Now it's like, I can sort of see where this can start to get bad, but I still don't lose sleep, to your point, or to your question. And even if I did, I don't know what the alternative is. You have to really be all in on betting against the U.S. if you're truly going to do something that's going to matter to protect yourself. And I don't know what that bet is. Is it German assets? Is it Japanese assets? Is it Swiss? I don't know. I'm not sure I'm going with this, but what are you going to do if it is a problem? Like, kind of like you sort of said before.
Yeah, that's an excellent point, Andy, too, about, hey, the economics of debt are different when you're a government issuing it and you're issuing your own currency versus a household finance. And then the main issue there is that as a household, you have to use dollars. If you could issue bucks, right, and people buy Andy bucks, yeah, sure, you can rack up a ton of debt if people, as long as people buy Andy bucks. U.S. government can issue dollars, U.S. bucks, basically, and so it's really a choice to default. But to your point, the real constraint on spending is inflation, and we're not seeing that right now. So there's mixed signals there. I think it's a reasonable concern, but again, it's not something that's flashing red at the moment. And I heard too in the news, bond interest rates, yield is kind of the fancy term for it. Bond interest rates are spiking. People are running to the exits or U.S. debt. They're seeing all the deficit. And the 10-year U.S. Treasury, which is kind of the benchmark for a lot of U.S. debt, when you hear U.S. government interest rates are going up, usually they're referring to the 10-year Treasury bond. Its interest rate is down year to date. It started the year at about 4.6 and it's at 4.5. So it's kind of a nothing burger there. But ultimately, when you think about debt, you always got to compare it to income, right? I mean, if I have a $5 million mortgage, that's really, really bad. But if Bill Gates has a $5 million mortgage, he's going to be okay because he's got a lot of assets to support that. U.S. government has the most assets in the world because it has the sole right to tax a $29 trillion economy. That's a heck of an asset, and that can support a lot of debt. How much? Nobody knows.
Yeah, right. And another example in the book, like you said, when you issue your own currency, it's a very different game. An example in the book I think she used was Greece. When Greece adopted the euro as its currency and got rid of Greek, was it lira? I don't even know what the currency was. It doesn't matter. But they got into trouble, and they had a big debt problem. This was like roughly 15 years ago, I want to say, because they didn't have the ability to issue their own currency. They were bound by the euro. And so they lost their autonomy. When you join the European Union or when you join the common currency, you have to give up interest rate policy. It's then centrally managed by Brussels. And so every country now lost its autonomy in being able to manage its currency supply and its interest rates and stuff like that. And that was one of the downsides of it, is they got stuck like a household budget. They got themselves in too much debt and got stuck. We're different. Japan's different because we issue our own currencies. It can do so at will. Again, inflation's the ultimate governor on when it's too much, but inflation isn't telling us it's a problem currently.
And neither is the market's prediction of future inflation either. The market
Correct.
isn't predicting, 5-6%, 5-10 years out. It's predicting 2.5, 3.
Historical average. Yeah.
Yeah.
All right. Anything else on this? I think we're good.
Yeah, I think we beat the dead horse.
We did, to death, and then some. Another thing you brought up to chat about is estate planning, talking to your kids and beneficiaries about it. Specifically, I guess the concern is someone passes and the heirs, the executor, was never aware of what the plans are or what to do at that point. So what are your thoughts on this, and where do you want to go with this?
Yeah, this is a client situation that really happened. I thought I would share it as kind of a cautionary tale to everyone to help with this. One, I think when you think your kids are mature enough to handle it, talk with them about how you're distributing your estate to prevent any family blow-ups. And so what happened with this client is actually it was them inheriting money. So they're in retirement age, they're in their 60s, but both their parents were in their late 90s, still alive. And the client's father, my client would ask her father, hey, what's going on with the estate, Dad? It'd be nice for us just to know. And this is Great Depression era, folks. And he said, everything you need to know is in the bottom cabinet. When I'm gone, just open it up and it's all there you need to know. Well, turns out he didn't talk to anybody how he distributed the estate, and some siblings were upset. And Mom got involved, and she actually changed how the estate was distributed because she wasn't even in the picture. She wasn't even told. And this isn't uncommon for that generation, where the man handles the money and the woman, just doesn't. A lot different today, obviously. But so there's huge family drama. People are upset at one another, and it all could have been avoided if he just sat down everyone and said, this is the way I'm distributing the money, and here's why. And I think that's a good lesson too, even for our clients, Andy, because you and I both work with people close to it in retirement. If you don't know how your parents' estate is distributed, it's not about how much money am I getting. It's, hey, I don't want this to break apart the family. Use my story as an example of something where people because he didn't explain to anyone, his wishes were there was a little gray area in them for misinterpretation, and it just led to a huge family drama. So use that as a cautionary tale for your parents' estate, and then for you passing on your assets to your children down the road.
I think that's great. Now, a lot of people struggle with the thought of their own mortality and don't like to talk about this stuff, but you really have to. I mean, we can't force you to, but we know it's inevitable. We're all going to die at some point. Maybe you don't care about the bird's nest of mess that you leave behind that someone else needs to figure out, but assuming you do, and you want to try to minimize the burden to whomever is responsible for not just administering your estate, but whoever is going to get the inheritances and stuff, have it all laid out as clearly as possible, what your wishes are clearly documented, and also documenting your wishes can take away a lot of the potential infighting amongst the heirs, right? So they don't have to figure out, what do we think Dad or Mom wanted? Like, no, it says it. Now, whether or not you agree with it, it's what it said. Now, be angry at your deceased parent for the share you got if it was less than the rest. Like, don't be angry at your siblings because you got you got less. It still might cause some animosity amongst the siblings, but yeah, I'm not really saying much here other than be as clear as possible, as detailed as possible, not just with your wishes, but where all the stuff is, your different accounts, and where the executor, executrix is to reach out to start the process of getting this stuff transferred to whoever it's going to.
Well, and that was another issue is because this was a not high 90s individual. He didn't believe in investing in the stock market. He only wanted CDs from banks, and he spread it around 20 different banks in the state. And so it was like a treasure hunt for them to go, and just the amount of paperwork, it took tens of hours to just consolidate it. So, and this isn't also my story. This is what Warren Buffett says too. That's his number one piece of estate planning. So if it's not like, hey, some random financial advisor podcast person told me, mom or dad, Warren Buffett says to do this. So that might help, maybe a little more cachet than no name Larry Pershing.
Yeah, well, Larry told me to do it, so whatever. Yeah.
Well, maybe Andy.
That and $1 won't even get you a cup of coffee nowadays. All right. Anything else you wanted to touch on with the estate planning thing?
No, I mean, the only other thing I can think of is another client situation has popped up recently where I was reviewing an estate document for them. So I went to a good estate plan attorney. He drafted a really great document. And obviously, I'm not an attorney, so I don't know the right language, but I see a lot of these, know generally how they work. And I said, okay, this all makes sense. I've seen similar situations like this. It's in Illinois, so we're avoiding Illinois estate taxes. But when you're avoiding estate taxes, the trusts get really complicated. You usually have like an A-B trust, you have multiple trusts, there's all this stuff going on. And the clients got so caught up in understanding how is this actually going to work that we forgot the basics, which is how's the money being distributed? And some of the money was not being distributed according to their wishes. They had wanted to give some money to nieces and nephews, and it ended up all just going to their siblings when they passed away. And then their nieces and nephews would get the money eventually. But they said, no, when I passed away, I wanted my nieces and nephews to get some money. And that got missed because it was kind of a moment of missing the forest for the trees, so to speak, because you're just overwhelmed with all those details. So it's always helpful, review your estate documents before you sign them and take like a day or two, give yourself some space so that you can actually see and say, hey, number one, is this accomplishing how I want my money to be distributed? It sounds so simple, but it happens, unfortunately, more than you would think.
Yeah. And the more structured you try to make it, the more you really have to pay attention to the devil in details in the wording. I helped a client who has 3 adult kids, and they wanted to split the money 3 ways, but one of the children has some history of addiction, substance abuse issues. So it was going to go into a trust where the plan was every year the kid would get 1/10 of what's in that trust. Mm-hmm. And that's how it was written. Basically, I'm paraphrasing, but that's essentially what the trust said. And I looked at it, I was like, well, what does that mean? What if it's let's say the kid shares $1 million on the day the parent dies? What does 1/10 of that mean every 10 years? Does he get $100,000 every year? Depending how that trust is invested, what if it grows to 120 the next year? Does he still only get $100,000? Like, it wasn't spelled out. So they went back and we kicked around some iterations, and I think ultimately came up to like the first year it's 1/10 of what's there, the second year it's 1/9 of what's there, the third year it's 1/8 of what's there. So regardless of the balance, it'll keep like prorating down over the course of 10 years. But anyway, so I think a lot of lawyers, not to say they're not math minded, but they think, okay, yeah, 1/10 per 10 years, great, whatever. But like, no, that doesn't work. Like, you got to spell out more specifically how that's going to mechanically happen. So,
and if you don't do that, you can get lawsuits, or you can get people really frustrated, and a lot of animosity can build. Again, that's not your intention, right? This is your, I like to say it's your last impression, your final impression. You get your first impression is important. Well, so is your last impression. And this is what, this is literally the last thing that's going to happen. This is the first thing people are going to remember about you after you pass. Maybe not the very first, but and these things can take months to wrap up. Even well-done estate plans, depending on the probate process and everything, it can be a lot. So I think that's great advice, Andy, really, to read it and understand the details, and put dollar amounts to things as well. When you put percentages in there, 4 or 5%, 10%, sounds like, well, also, wait, what happens if it's $1 million? Now that's 100. Do they need 100,000? It can get tricky.
And this is where advisors come in. Like you said, we're not lawyers. We can't draft or execute trusts or wills, but we could be an independent party to help review it and give our take on it. Is it accomplishing what we believe the client wants it to accomplish? Maybe it is, maybe it isn't, and we can kind of recommend changes if possible. So there's value to be had with a good advisor who knows how to help think through this stuff. We can't, cross the T's, dot the I's, so to say. But
also, Andy, I'd say definitely think through, but also implement. Because the other biggest mistake I see is we've got this great estate plan in place, we never changed the bank account to the trust.
Right.
We never updated the joint account to the trust. And that's where, well, we can't touch bank accounts, but we can actually do some of the heavy lifting of the implementation with updating the beneficiaries on the investment accounts, the titling of non-retirement accounts, individual, joint, et cetera, all that good stuff. So we can also help implement it too, and still just hold your feet to the fire. Since you're going to be seeing us, it's not one and done. We're going to be seeing you, and hey, I have a note. Did you update the bank account, beneficiary?
No.
Did you get it? So that's also always helpful.
Great points. Alrighty, chugging along. Estimated taxes. So if someone retires this year, do they have to think about how they're going to pay taxes going forward? So like now we are June 9th as of we're recording this. Do they need to make an estimated payment by June 16th? Technically it is this year. Or not? What should people think about as they're retiring and paying their taxes in retirement?
Yeah, it's a great question, and obviously it's individualized to everyone's situation. You have to actually go and run kind of the tax projection of saying, hey, okay, what is my income going to be this year? Now there's some safe harbors depending on your income from last year, but what I find, especially as people the first year they retire, a lot of people tend to retire at the beginning of the year. Andy, I don't know if you this goes with your experience, but I feel like a lot of people retire either at the beginning of the year or like very end of the year, like December 31st, like clean cut. But if you're retiring mid-year, it's usually towards the beginning rather than the end. And then it's easier when you retire at the end of the year because you've probably been withholding from your paycheck. Estimated taxes might not be as big of a deal, but at the beginning of the year, you've been withholding from your paycheck. Now all of a sudden, you've got the rest of the year to go, and you want to make sure you do this. Think about it. Either ask your tax preparer, and a lot of times on tax returns it'll say here's your estimated tax payments to make for the upcoming year, but all that is number crunching. Usually it just spits out what your income was for last year. It makes that assumption and says, okay, here's your withholding stays the same from last year, here's what you have to do for this year. But obviously if you're retiring, big difference, probably less. You probably have to make less estimated tax payments. But one last gotcha I've seen with this is we retire at the beginning of the year, we've got all this money, okay, first half of the year. Then we kind of have like low income, maybe we have some cash saved up or whatever it is where we're not recognizing a lot of income. And at the end of the year, we go, oh, hey, we've got a low income year. Let's lock in some low tax rates with a Roth conversion. Okay, great. Except now, when we do that conversion, you might get hit with an underpayment penalty because you have all this lumpy income at the end of the year with the conversion. And the way the IRS trues this up is they just assume starting out that all of your income is earned equally throughout the year. And so the IRS is going to say, wait a second, this conversion you did at the end of the year, I don't know that as the IRS, so I'm just going to assume you did it equally throughout the year. And hey, you should have made estimated payments, and now you're going to owe a tax penalty. And so that's something just to think about, especially if you're considering doing some sort of tax planning, tax strategy at the end of the year, and you're retiring at the beginning of the year. You want to have a plan for estimated tax payments.
Now, speaking of, where can people go to use estimation tools, projection tools? What options are out there? Because that's a common question. Like if you've worked your whole life, you've never made an estimated payment, let's say, because taxes are withheld from your paychecks. Never had to think about this. Now you're retired. You do have to think about it. Where do you even start to cook up an estimate of what do I think my taxes may be for the year so I can pay them?
So I use Holistiplan, and that's a professional tax projection software. So it's not really available to the public, so to speak, or, I don't know most people are going to spend several $1,000s for estimated taxes. So this is not a recommendation. I'm not taking any liability for this tool, but at the beginning of my career, I didn't have access to the tools I have today. And there was a free resource called Excel1040.com. And I think it's just this guy, volunteer, he basically recreates the whole tax return in Excel, and you download this big Excel spreadsheet. And several years ago, I used it, and it worked great. Now, I don't know if he's keeping it updated. It could be terrible, so do your own due diligence on it. This isn't a recommendation, but I used it before. It was great, so that's one resource to point out. I think Dinkytown, although I don't know if they do estimated tax projection, but essentially you have to run your own pro forma. You have to run a projected tax return. The Excel1040.com used it pretty well. You got to be good with, you have to be decent in Excel. You don't even have to be great at it because it's already there. You just got to understand where all the numbers flow and take some time to kick it through. But Andy, what about you? What would you say to folks?
So, yeah, I mean, within the business, I use commercial tax prep software that does it, and we also have Holistiplan as well. So that's what we use. But for consumers, like TurboTax has it. It might be an extra cost you have to pay, especially if you're using the free TurboTax version. The Dinkytown one, like you mentioned, I've heard of the Excel 1040. I never used it myself. But Dinkytown, something similar. The difference, I think, is it's not a downloadable Excel thing. It is a web-based form that you fill in. But similarly, it used to be, I don't know if it still is, but just made by some guy who took it upon himself to create it, maintain it. Really good for the vast majority of stuff. I assume it has limitations, like if you get really in the weeds with like business taxes or something, but that's accurate, especially for most people listening in rather plain vanilla tax situations. The IRS has a really good estimator tool, straight from the horse's mouth. Now, it's a series of questions and prompts. It can take a while to go through, but it'll ask you, like, what are your wages, if any? What's your interest? What's your dividends? What taxes were withheld? So, like, you do need your most recent pay stub in front of you. You do need, ideally, last year's tax return and some other stuff. But it's just questions after question after question that you answer, assuming accurately, and it'll tell you, okay, to avoid any estimated underpayment penalties, make these estimated tax payments for the rest of the year. So that's another option as well. If I remember, I'll put a link to it, but just Google like IRS estimated tax calculator, and you'll find this thing. And the more complicated your return, I mean, this can take you a half hour to do because there are a lot of questions to it. But for pretty plain vanilla stuff, maybe it's 15 minutes to rip through it, and it'll give you really accurate figures of what to pay in estimated taxes. So,
it's a great point.
All right. Okay. This is a question I got from someone recently that I had a call with. The S&P 500, and this is not investment advice, never is, never was, never will be, but the Standard & Poor's 500 is an index that captures the prices of the 500 largest publicly traded companies in the U.S. and what their market capitalization is, or number of shares outstanding multiplied by share price. It's very concentrated in the top few names. I just looked earlier today, and the top 5 names: NVIDIA, Microsoft, Apple, Amazon, and Google. Specifically, there's 2 share classes of Google. I'm lumping them together into one because it's all Google ultimately. Those 5 names represent 29.72% of the 500 names in the S&P 500. The next 5 largest, Meta, which is Facebook/Instagram, Broadcom, Berkshire Hathaway, Tesla, and Walmart, together the top 10 now are just shy of 40% of the total index. Now, most of those names are large tech companies: NVIDIA, Microsoft, Apple, Amazon. I don't know what you call that. It's part tech, part retail, part other stuff. Google, Meta, Broadcom. Tesla's not, Walmart's not. But clearly, very large concentration to large tech companies. And we had someone ask us, well, what do you do to manage around that? When we said that we just use broad index funds such as S&P 500 and also some small and mid-cap exposure. And it is what it is. We acknowledge the S&P 500 is concentrated in these top names, but for better or worse, that is the makeup of the U.S. stock market when viewing it on a market capitalization basis, where again, market capitalization is number of shares outstanding times share price. These companies really do dominate the U.S. stock market, again, for better or worse. We don't try to hedge that, to minimize that, to intentionally reweight our stock exposures by holding a really small position in the S&P, then larger positions in like sector-specific funds that aren't technology. We follow the U.S. index for right or for wrong, for better or for worse. And some people might not be okay with that, and I get it, but what are your thoughts or views about the concentration in the S&P 500, and do you do anything about it in terms of like shifting your investment exposure, trying to minimize the concentration to tech?
Yeah, Andy, we have a really similar philosophy on this. We're going to have to start disagreeing more to spice. You said this was a spicy episode, I think, at the beginning.
Tell me I'm an idiot and I'm wrong. I mean, lie. Come up with something. I don't know. Yeah.
So I've also gotten this question with clients, and I completely agree with you of, hey, indexing is the way to go. I love the way you described it. You're betting against the collective market wisdom when you go against it, and the odds are not in your favor when you do that. But the other thing I like to walk through clients is like, hey, just for an example, let's say you've got $1 million, keep the math simple. You're invested in a 60% stock, 40% bond portfolio, the classic 60-40. So that means $1 million portfolio, we got $600,000 invested in stocks, okay? So in our 60-40 model, about 30% of the total $1 million is going to be invested in the S&P 500, okay? Now, not saying this is right for you. This is just, what we do, and do your own diligence, not investment advice, all that good stuff. So $1 million portfolio, 30% of it is in the S&P 500. So that's $300,000 invested in the S&P 500. Andy, you just brought up the numbers there, right? Roughly, these large technology companies are roughly 30% of the S&P 500, right? So of that $300,000, 30% equals $100,000. So we've got $100,000 spread out across these technology companies. And I think you said, what is it? There's like 7 of them, FANGR, whatever the acronym is. Right. Or even I think you said the top 5 was 30%.
Top 5's 30, yeah.
Yeah, so let's even go top 5, okay? So we have $100,000 invested in the top 5. That's $20,000 invested in each roughly. Now, really, I think Apple's the number one. That's going to have a little bit more. Maybe Apple's 27%, and the fifth one, the fifth lowest is only 20,000 or 17,000. But whatever it is, it's kind of close enough. So okay, out of a $1 million portfolio, we've got $25,000 invested in the top holding. Is that unreasonable? I mean, when we kind of break it down, and the point here is that we're diversified, right? It's not all in the S&P 500. And Andy, correct me if I'm wrong, but when your client says, "Hey, I want 60% of my portfolio in stock," do you put it all in the S&P 500?
No, and this isn't investing advice, but no, the stock portion usually gets split between S&P 500, which again is just the 500 largest companies in the U.S. There's also a portion that goes into small and mid-cap, mid-sized U.S. companies, and then a portion that goes into international, so non-U.S. companies.
Exactly, so, and same here, and that's why I said, hey, if we're a 60-40 portfolio, about 30% is in the S&P 500. It's the largest stock holding in the way you group it, but still, when you kind of dice it down to the numbers, having $25,000 in your top stock holding on $1 million portfolio, it's like 2.5%. Hey, maybe that's too much, but most of the time when I break it down to dollars with clients, we go, that's fine, Larry.
Right.
Never mind, I'm okay with that. And sometimes they're like, wait, that's all? Why can't we invest more? I go, hey, wait a second. You told me you wanted less. You can't now all of a sudden say you want more. Right. But at the end of the day, we're going to let the market decide how much is in it, and that works out really well over time. Not that past performance is guaranteed future result, all that good stuff.
And the more you start to stray, and this is what I said on this call, the more you start to stray from whatever the market is, the more you are inherently speculating on, you think this is going to do better than the market as a whole. So for example, yes, there is a lot of exposure within the S&P 500 to technology, but what are you going to do differently? How do you know across the roughly 10 or 12 sectors that there are, what is the right mix? And without you consciously or subconsciously thinking that one sector is going to do better than another, how do you know what the allocations are? Or even just if you inherently just split your stock allocation equally across, let's say it's 12 sectors, I don't know what the actual count is, as opposed to letting tech be a third like it is in the market, whatever, you're inherently saying, I think these other sectors are going to outperform relative to tech. If not, you wouldn't have intentionally reduced your tech exposure compared to what it is. So the more you stray from what the market is, the more you're just gambling and speculating about thinking the market collectively doesn't know what's best. Now the market, is all just guessing about the future anyway. So I don't have a basis to know what are the right allocations of sectors or growth versus value or whatever. Not to say there aren't people out there that do try to make that their value proposition in stock picking and sector picking and whatever. And history has shown more times than not, you're not going to consistently do better than the market itself when you try to get active and fancy.
Yeah, and I love that you brought up, hey, there are professionals who spend a lot of time, effort, and resources into doing this, more often than not, they're wrong. But also, buying the index fund, we get to piggyback off all their time, effort, and resources spent because they are buying and selling and moving stock prices towards what they think is true value. And index funds, we just buy the market price. We get to use the collective market's wisdom of what is the correct allocation. That's why it's so hard to beat, because essentially we get to piggyback off all of their hard work and effort. And there's one guy who thinks, growth is the way to go, and there's one gal who thinks, no, we don't want those growth companies, we want value. The market price reflects the relative weightings of all investors' thoughts. And finally, I'd say, Andy, let's just say, hey, for a second, you're right, okay? You need to get out of the large tech companies because they're going to underperform the market, okay? So you're right, you do that. Well, now what? When do you go back to the market weighting? Or do you just hold the other ones? And what if tech bounces back and you outperformed over 3 years, but over 10 years you get crushed because you missed? I mean, that's the other hard thing, is that it's not just making one decision right. You have to at least make two decisions right. When to get out of the index and when to get back in. Or if you're out of the index, it's a continuous chain of decisions, of active decision making. And I think that the data is really clear on this. The more decisions we make going against the index, just in raw decision count, the more likely you are to underperform the index. It's much easier to beat the market once. It's harder to beat it twice, really hard to beat, and so on and so forth. So, that's my story. I'm sticking to it.
Yeah. I like that we said about there's so many active professional managers out there trying to find an edge and outperform the market. I've always said and thought that passive index investing works as well as it does, and historically consistently does better than active investing, because there's so many active investors out there all chasing the same opportunities. To the extent there is any asymmetry in information or any inefficiencies in the market, they're going to find it, they're going to arbitrage it away, and it brings it back to like just investing in the market is going to end up beating that. Like, nobody listening has an information edge, or I guarantee you don't have an information edge over the professionals. Not just like actual information in your head, but even like technological information, their ability to screen through conference calls and pick out stuff and act on those things in a fraction of a second. Even like the pipes and plumbing between, like, there's some high frequency trading places that get information infinitesimally faster than everyone else because they have low latency and less travel length between wires, and like that stuff matters in the big institutional world. The average, anyone listening is never, ever going to be able to beat that edge. So don't even bother trying. A little off on a tangent here, but yeah. So passive works because there's so many active people. If and when there's less active managers and the market becomes more inefficient, then passive may not have an edge, but quickly the market will fix itself. More active people will get into the market, right? Because they see the opportunity, they're going to arbitrage it away, and we'll be back to where we are now. So.
Well, and Andy, listeners don't have to take your word for it. Warren Buffett has said the same thing, that it's harder to outperform the market than when he started 60, 70 years ago. And Munger, his business partner too, he put a substantial part of money in a investment manager who mainly invested in China because the markets weren't as developed, and there was actually more arbitrage active management opportunities in a emerging market than a developed market like the US. So, hey, I mean, maybe there are some pockets of the market that active management could make sense. But even internationally, I mean, I'll say we use index funds as well, just because it's still pretty darn hard to beat the index. But in the US markets, the S&P 500, I mean, the math shows for publicly traded firms, roughly 90% of them underperform on longer time scales, 10 plus years. And the longer the time period you look, the less people outperform the market. So what that tells you is it's not skill, or there is some skill to it, but there's a large luck component. Because if you have 10,000 people investing, some of them are going to outperform just based on raw numbers alone. But if the amount of people outperforming decreases over time, that's not a good sign that what they're doing is truly skill based versus luck based.
Yeah. This isn't the same math, but you have 10,000 people, have everyone keep flipping a coin. Someone's going to keep getting heads consecutively, one after another, they're going to look like a genius, right? It's like, no, it's just a stats and law of large numbers. Like, someone's going to keep flipping heads 5-6 times in a row, if not longer. But anyway, all right. let's move on from that. I think what else do we have here? Just looking at my other two things. We've got two more questions. Let's do this last one more, see how long this takes us, and then just a question about fees. This always comes up. I took this one out of the Facebook group. I see a question like this every other week or so. The question said, the post was, I'm talking to a money manager at one of the large firms. His fee is 1.75%. I assume she means percent of assets under management. Does that seem reasonable? Question mark. He will be managing less than $200,000, but hopefully he will grow it. How would you respond?
I'm going to tell you a story. A couple weeks ago at 11 p.m., I'm going to bed, and I hear water running in my bathroom outside my bedroom. I go, I didn't leave the faucet on. Walk out, water fixture broke, water's flooding in the bathroom. I quickly turn it off. I go downstairs, water's leaking from the ceiling. It was on for like a couple minutes at most. So I shut off the whole house water. I don't know what's going on. I've got an 11-month-old in the house sleeping, and my wife is out of town. So I've got no water, no wife. That's not a good situation. So I wake up Sunday morning. I go to bed because it's 10 p.m. on a Saturday. I wake up Sunday morning, 7 a.m. I start calling plumbers. I'm not handy like you, Andy. I'm bad. You know, I'm a nerd. I'm stuck in the number. That's why I do financial planning. And plumber says, great, I can be there in 2 hours at 9 a.m. on a Sunday. I go, fantastic. He goes, he comes, fixes it in 30 minutes, $500 bill. You know, could I have gotten somebody to do it cheaper? You bet. But I really needed the help at that moment. And I went with like the big plumbing firm where they advertise everywhere, and, you know, they might have private equity, and you know, it's just like, he's not your local plumber who, if I waited till Monday, I probably could have gotten half the price at least. But I needed it fixed now. And so when I hear somebody say, is it worth the fee, to me, it's, well, one, like how dire is your situation? If you're like, I feel a lot of analysis paralysis, I can't invest, I'm scared, and you feel comfortable with someone and they're charging that fee, fine, you'll probably be better off. Even with that's an above average fee, just like I paid the above average price for the plumber. But if you're in a desperate situation, not that they're going to grow enough to like get you to retirement, that's where desperation, no amount of fee is going to fix. I think it's reasonable. And especially, what are you getting for that fee? If they're just managing your money, it's expensive. But again, if you truly feel comfortable with them and they're charging above market rate, but you've interviewed other advisors and they're the one, I'd be okay with it. But probably if you look around, you'll find a smaller fee for the same price. But also, too, what else are they giving you? Are they doing more than just managing your money? You know, are you getting negotiation advice, tax planning, insurance? Are they looking over your employee benefits? All that good stuff can make the fee worth it. So, you know, if you're not in a dire situation, I'd say interview a couple other advisors and see. But if that's the one you found that you really think is best, just know you're probably paying an above market rate, but you could still see the value from it. Maybe we'll disagree on this one, Andy. What's your thoughts?
I think I agree and disagree. I agree in that the fee for anything, any product, any service, is it worth it to you for whatever your reasons are? The more you need it, the more you should be willing and able, the more you can justify paying a higher fee than what you can maybe get elsewhere, especially if it's a service that, in your case, like can come ASAP as opposed to come a day later. So advisory services aren't quite the same because there's not like 24-hour emergency advisors like there are plumbers. But I
my phone is off at 3 a.m. Don't call.
Okay, so maybe there's an advisor that will be available at 3 a.m. to answer those burning questions about national deficit, whereas you're sleeping. I always say, don't look at I hate is 1% too much, is 1.75% too much. I always say look at the dollars. It's the dollars that matter. Compare the dollars you pay versus what you're getting, and do you think it's worth it for you? I'm confident that the vast majority of value and good advisory service isn't something that could be indisputably numerically quantified and say, oh, I'm going to be $4,000 better off this year. So if I'm only paying $3,500 a year on my $200,000 under management, paying 1.75%, then it's worth it. Like, it's not that easy. There's peace of mind value you can't quite quantify. There's other longer term planning things that should end up producing value, but we're never going to know until after the fact, 20, 30, 40 years down the road. So know the fee in dollars. Are you comfortable with it? And look at what you're getting and compare that versus other places to the extent you have the time and interest to actually shop around and find someone who's a good fit, who provides the services you want, who seems to be knowledgeable and experienced in it. I don't feel on the surface that this fee is too high because it's $3,500 a year is what 1.75% comes out to on 200 grand. I feel like as an advisor, unless they're doing absolutely just cut rate, completely like automated pre-canned investment model where they're not, you can't even talk to them. It's like, nope, you just got our stripped down digital only service. There's got to be some dollar amount of floor to what the advisor get paid for the year, right? And $3,500 isn't terribly a lot if they're a halfway decent advisor and you can talk to them throughout the year and whatever. And there's other services, right? So 1.75 isn't necessarily a lot just as a percentage. If this person had $2 million and it's 1.75%, then that's crazy expensive because that's 35 grand a year. And if they're not doing anything ultra complex for them or like mowing their grass for them as well, for the vast majority of people, 35 grand a year is going to be way too much fee to pay. So that's why I just kind of come around to like, don't look at the percentage, look at the dollars you're paying compared to what you're getting. Maybe it's fair, maybe it's not.
I think it's a great point, and it kind of goes back to like, hey, investing the tech sector in the stock market. Like, well, how much money do you actually have invested in these stocks? How overweighted are you? Put in dollars in the estate plan. But this is kind of a theme of this episode, Andy. It was like, he'll put in dollar amounts, what the distributions are. But if you see a percentage, put it in dollar amounts. I think is a good takeaway from this episode.
I might put that on a shirt. Maybe that'll be a new slogan of the show. Like, what is that in dollars or something? I don't know. Okay, final one.
Anti-percent club.
That's a good one. I like that. Let's see where we go with this. So just a couple days ago, this was June 7th, this came out. The Wall Street Journal had an article about the 401k hierarchy of distributions. The story was about there was someone who took a distribution from their 401k, and they didn't look into how is the plan, the fund actually, what funds are they selling off to free up the cash to meet this distribution? This particular plan had what they called a hierarchy approach, where by default they are selling off the the ones with the funds with the lowest risk within the plan. And the person didn't know that. And so in doing that, it sold off some of the lowest risk funds, therefore leaving what was left to be further concentrated in the riskier stuff, which wasn't appropriate for this person. Now, I don't think they ended up like, losing their life savings over it, but point is, this could be a big deal if you're taking out a lot of money or, whatever. So I actually didn't know this. I didn't know any plans have this hierarchy approach. News to me. So
news to me too. Never seen it in the wild.
That was the first cool thing. But just, I thought this would be interesting to address bigger picture. What are your thoughts or things people should look out for if they decide to leave money behind in a 401k as opposed to roll it to an IRA? Maybe we talk about that briefly if you want, but that aside, for people that do decide to leave money behind in a 401, like what types of things should they watch out for or look into with regards to taking distributions?
Well, I'm going to add that to my checklist now because I saw the same article in the Wall Street Journal. I was like, wow, I've never seen that before. And seen a decent amount of 401k plans, seen a decent amount of distributions, and always I've seen it's pro rata. It's kind of equally from each fund, which has its own issues too, because normally it comes out an equal share. So if you're 50% S&P 500 and 50% bond, it'll come 50-50, and maybe, the market's down and you want all of it to come from the bond fund. So we then afterwards have to go in and say, hey, you got to manually rebalance this, and it's all in percentages. Always put it in dollars. Mm-hmm. Anti-percentage club. So I mean that's kind of a whole new issue there. But some other things to think about is one, it's just another account. It's more complexity. So you can roll it over to an IRA. You can consolidate everything. You're just having another account out there. Now, while you're working, the advantage of this is that if you get all of your IRA money out into a 401k, all of your pre-tax IRA money, then you can do the backdoor Roth IRA contribution rule. You don't get hit with the pro rata rule because it's all in your 401k. So that's kind of the advantage there. And I guess the disadvantage of then moving it out of the 401k or rolling it over is if you're still working and you have high enough income, you might not be able to do the backdoor Roth contribution anymore. So, there's one thing there. I think one disadvantage I hear people often say about 401ks, which recently got changed, is it used to be that if you had Roth money in a 401k, you had to take RMDs off it. But then Secure Act 2.0 or the updated regulations, this was recently kind of changed in the last few years, where now if you have Roth money in a 401k, you don't have to take RMDs from it. And if you have a Roth IRA, you also don't have to take RMDs from that. So it's equalized. Before, it tilted the advantage to IRA, so it was a disadvantage to the 401k. Now they've made the playing field equal, except, so for you, you don't have to take RMDs from your Roth 401k, playing field equal. But for your beneficiaries, playing field still is unequal. And it's disadvantageous to have money in the Roth 401k. So if you have money in a Roth 401k, you pass away, your beneficiary gets it, and they're subject to the 10-year rule, then they have to take annual RMDs from that Roth money each year, then it has to all be gone by that last 10th year. Versus if you had rolled the money over into a Roth IRA, you pass away, your beneficiary gets an inherited Roth IRA subject to the 10-year rule, then they don't have to take money out of that Roth IRA until the last day of that 10th year. So you have more time in that sweet tax-free growth zone of the Roth IRA, and hopefully that'll save you some taxes over the year. So that's a disadvantage for kind of inheriting assets. One more complication to this, though. If you have, that's only in effect where you have to take RMDs from the Roth 401k portion of your account for inherited beneficiaries if they inherit a pre-tax and a Roth. So if there's pre-tax and Roth money in the 401k. If the 401k is just Roth money and the beneficiary inherits it, they aren't subject to that RMD rule. But what I'm seeing more and more with clients, Andy, and I don't know if you see this, more and more people have a mixture. It's not all or nothing. When I began my career, most of the time it was just pre-tax. But now the Roth option is much more available. Highly compensated people are going to start to get catch-up contributions as Roths whenever the IRS says they have to start doing that. So really Roth has become a bigger thing, so it's much more common to see mixtures there. I don't know, you can't, I guess if you have an advisor, you can't, if you have an IRA account, advisor can manage it, they can debit their fee and it comes out pre-tax, at least a portion of the advisory fee can come out pre-tax. Most of the time you can't do that in a 401k, but if you don't have an advisor, you don't really care. It's more of a pain to do distributions with 401k, more paperwork. There might be rules around how many you can do a year with IRAs. It's a lot simpler. Tax withholding simpler. You have the 60-day IRA rollover rule too. So if you make a boo-boo, you take too much money out of your IRA, within 60 days you can put it back and no one's the wiser. You can only do that once every 365 days though, so be careful about that. Don't have that with the 401k, so that's a disadvantage. That's all I got, Andy. What about you?
No, I agree. Generally speaking, I do think it makes sense to consolidate and roll over old employer plans into an IRA for the reasons you mentioned. There's not a lot of very obvious cases where, like, yeah, definitely leave it behind in the 401k. The one biggie is the Rule of 55 thing, where if someone separates from service from the employer in the year they turn 55 or older, they can access that 401k, take distributions from it penalty-free. They don't have to wait till 59 and a half like they would if they rolled that 401k over to an IRA. They then lose that Rule of 55 benefit. So if someone's of an age where that matters, and the plan allows it. Now, here's what I mean by the plan allows it. It's an IRS rule that says the 10% penalty is waived if you separate from service from an employer plan in the year you're 55 or older and take money out of that plan. So in that sense, the employer can't like override and turn that off, but they can restrict you from taking distributions. For example, I have a client where her 401k said once you retire, you're allowed one distribution in your lifetime. Which basically means you could take it all out in one big fat distribution, which no one's going to do. That's way too much taxable income. Or you can roll it over. That's your one distribution. Or I think maybe they would have let you split it. So you can roll over like 90% of it and actually distribute out 10%, but you get one chance to take money out. And so, like, practically speaking, you can't tap that annually for income. So it kind of negates having the rule of 55 and the penalty-free ability to access it, because you get one chance to take money out of it. So that's what I mean by if the plan allows it. The plans can't technically disallow the rule of 55, but they can have really prohibitive restrictions around the ability to take money out of the plan. So I did write a big article about this a few months ago. I'll link that if I can remember. I should probably write notes down and just saying, instead of just saying if I remember it. But it did detail through all the pros and cons of doing a rollover versus not. And my takeaway was the one biggie where you really need to consider leaving it there is the rule of 55. Outside of that, generally speaking, it makes more sense to put it into an IRA.
Now, Andy, it's interesting that both you and I didn't mention investments in this as a pro or con. What's your take on the whole investment in the 401k versus IRA?
So that could matter depending on your plan, and generally the larger companies will have low-cost index fund options available in their plan. Maybe they're slightly more expensive by 0.01% per year expense ratio or something, but often that'll be a push. The same funds we invest in, index funds, are likely available in some form or fashion in many 401k plans, especially again larger employees. So that's kind of a non-issue. The thing you brought up before, the ability to decide what gets sold when you take a distribution, could very much matter. In an IRA, you can cherry pick just certain investments to sell to free up cash. In a 401k, typically, it's just a prorated sale across everything that's in there. So it takes away some of your ability to manage sequence of return risk and sell just stocks or just bonds. So that's another reason why, again, rolling over to IRA usually makes sense, but it is quite possible the fund lineup and expenses of those funds could be very similar in a 401k to what we would use in an IRA. You have anything to add?
Yeah, no, I agree with that completely. That, hey, I mean, it is possible. I feel like, again, this is one of those areas where 401ks have gotten much better.
Yes. Yeah.
In my time in the industry, and most of the time they have really, and sometimes I've even seen 401k plans that the larger employers will have better investment options than we do, because they have the institutional S&P 500 index fund, for example, and it's I think it's 0.02%, and Vanguard's ETF is 0.03, so it's 1 basis point lower. But to your point, Andy, about how maybe it's a little bit more expensive, if it's also just a little bit less expensive, that's not that big of a deal either.
Just to put numbers to it, 0.01% on $1 million is $100 a year. Does that matter? I'd say no. So either way.
Yeah, and how simple do you want to make your life? Yeah. Most people are going to say, I want to add $1 million in a 401k plan, are going to say, I want my life a little bit simpler. But yes, I think most of the time investment options are realistic. And two, you can always, if the 401k has some good options and some bad options, you can say, hey, I'll invest in the good options, and my outside accounts, I'll use the bad options. But then it makes it much more difficult to manage. So that's the other thing. It's managing the overall picture together with the 401k. That does remind me, though, TSP for federal government employees. TSP has one investment in it that you cannot get anywhere else, the G Fund. Love the G Fund. Not that that's investment advice, but G Fund, for those who don't know, essentially it gives you an intermediate bond interest rate, intermediate Treasury bond interest rate, but it acts like cash. It can never lose value, but it gives you an interest rate for intermediate term Treasury bonds. So generally, it's a higher interest rate than short-term bonds. Now, actually, recently, short-term rates have been higher than intermediate. So the G Fund hasn't been the end-all, be-all. But I think recently it just switched back to being a little bit higher. I know for my federal government employees, we leave money in the TSP specifically because we want to keep the option of investing in the G Fund, even if it's not today. Historically, G Fund's been the best cash option around, essentially. So we'll leave some money in there. So that would be one niche investment instance I can think of.
Great point. Yeah, the G Fund is the only unique investment option within there that you can't easily replicate for cheaper outside in an IRA.
Absolutely.
Same thing. I work with some federal employees where we kept some money behind in the TSP just to put in the G Fund. And what's nice about it is you can put money back into the G Fund, or back into the TSP, even after you're retired. Most 401ks won't let you do that. Once you retire, any money you take out, it's gone. They won't let you put new money into it.
One-way street.
TSP will. Yeah, TSP is
Really?
two-way street, which is nice. Yeah.
Two-way street.
You need to keep, it used to be at least, I want to say $2,000 in there. And you can only put money back into the pre-tax TSP. You can't put money into the Roth after you're gone.
Interesting.
Don't know why, but go figure. With that in mind, we do have some clients where their 401k, the unique investment option there is a G fund-like thing called either a stable value fund or managed income portfolio. Same thing. It's like a savings account, principal protected. You can never lose value. Historically, the interest rates were higher than what you can get out in the market. That hasn't been the case the last few years, with short-term treasuries paying 4 to 5% depending on the year. But we do have some clients that left some money behind in 401k just for the stable value fund. The rest of the stuff we can easily replicate outside for a little cheaper. So anyway.
Great point. Yeah, and that's a great tip about the TSP where you can roll it back into the money as well. So you have a little more flexibility there with it.
Definitely. All right.
Oh, Andy.
Yes.
All right. One last thing on 401k. We also didn't mention asset protection, 401k versus IRAs. Now, I don't know about you. One, I'm not an attorney, so this isn't legal advice. But two, every time I talk to attorneys about this, I never get a straight answer on how much more protected your money is inside a 401k than an IRA. It seems like because it's ERISA, federal government, bankruptcy protection, you get a little bit more than an IRA, but I never get a straight answer. Do you ever get a straight answer from an attorney about the benefits of that 401k versus IRA?
It depends who you ask. I'll get different types of answers. What I've since gathered and learned from Ed Slott and have researched on my own, so I'm pretty confident in this answer. There's two protections to be concerned of. One is bankruptcy protection. You become insolvent, and is this account able to to go after from your creditors? And the other is general creditor protection. So someone slips and falls on your sidewalk, breaks their neck, can they come after you for money that's in this retirement account? In a 401k, or any account covered by ERISA, the Employee Retirement Income Security Act, completely protected from general creditors, completely protected from bankruptcy as well. When you roll the money out of a 401k into an IRA, this is where it gets messy. The amount of money that was rolled maintains the unlimited bankruptcy protection that it had while in ERISA, plus any money you directly contribute to the IRA has separate federal bankruptcy protection. I forget the amount, it's over $1 million.
That's IRA contributions.
That's IRA contributions and growth thereon is covered under a separate $1 million+ federal bankruptcy limit, not general creditor protection, but bankruptcy protection. So for all intents and purposes, bankruptcy protection is a non-issue, whether you contribute money to an IRA and or roll it out of a 401k, because the amount's so large that you're probably never going to hit it. The general creditor protection is the one potential sticking point. There's a chart I found on some legal website that summarizes each state's statute and citation of the code as it relates to protection of IRAs from creditors. Vast majority of states fully protect IRAs from all creditors, including general creditor stuff like slip and fall lawsuits. And so the concern is that when money's in a 401k, federal overarching regulation says completely off limits to creditors, including slip and fall lawsuits. Once the money is rolled out to an IRA, it's then the state that determines the creditor protection, if any. Vast majority of states fully exempt IRAs, Roth IRAs from general creditor attachment. Some states don't. I don't remember the list off the top of my head, but like Michigan, for example, if I remember this correctly, only allows one retirement account to be fully exempted. So like if you have a Roth IRA and an IRA, only one of those is fully protected from creditors. I don't know the math to figure out, can you choose if it's one or the other, but apparently only one. I'm forgetting other ones. California, I want to say the protection is worded vaguely. It's like, to the extent you need this money to support yourself in retirement, it's exempted from creditors. I don't know what that means. That reads to me like push comes to shove, you got to go to court and the judge will decide how much of this you actually need, in which case that much is off limits. The rest is potentially subject to attachment. So what does this mean? For the vast majority of people, I mean, I think look up your state and what its protections are. This may all be a big fat nothing burger in terms of this creditor protection thing. In the states where it might matter, I guess now you never know if you're high lawsuit risk or not, but if you're like a slumlord and you have a bunch of, properties that are run down and kids are going to fall out of the windows and whatever, you're at higher risk of getting sued for stuff like that. So you probably want to consider the better protection. Maybe you do leave your money in a 401k as opposed to roll it to an IRA. But generally speaking, I don't think this is an issue people need to worry about or should worry about for the most part.
That was an excellent explanation.
Well, thank you. Hopefully it's right. It sounds good to me, and I'm pretty confident that that's the actual treatment of this stuff. Unfortunately, I do think it comes down to like if you actually get sued, and if you're in one of these states like California, where it's like it's protected to the extent you need it for retirement. Like, what does that mean? I'm not aware of any actual cases or outcomes or legal precedent to use as a guidepost for what to actually assume the protection is. So I don't know.
And the benefits of an umbrella policy as well.
Well, yeah, that too. I mean,
worried about it.
Yeah, right. That'll go a really long way. Get $1 million, $2 million, $3 million of umbrella insurance, which covers general liability that sits on top of the liability coverage you have in your homeowners and auto policy. That's a relatively cheap backstop to help protect this and make this even more of a non-issue or much less of an issue for people. So. Great point. All right, we wrap it here.
I mean, man, we're going on what, an hour and a half? I think so.
Yeah, let's just roll this.
Viewers might be asleep.
At this point. Right. Your kid's almost 12 months old now. By the end of this episode.
Yeah. My child is now 1 month older.
Anyway, okay, I guess we will stop it there. Larry, this was awesome. Thank you. Great topics you brought up here and great elaboration. Great thoughts you shared on these topics. And hopefully everyone got a lot out of it. So thank you for coming on and sharing your time and knowledge.
Yeah, well, I really appreciate it, Andy. Thanks for having me on this and just for everything you do. I can vouch for Andy. He's a great guy on and off the camera or the mic. He's done a lot for me and my firm. And I think you just recently hired a new advisor, correct? So is there some capacity at your firm if folks were interested in working with the Tenon Financial Group?
Yeah, that is correct. Brad Flood started here last month, May 2025, and is actively taking on new relationships now. So, yeah.
Good to know.
Very good. Yeah. He's a really sharp cat, and so far things are going swimmingly well with him as we record this June 9th, 2025. So looking forward to good things to come for him and for Tenon Financial as a whole, and clients.
Keep it up, Brad.
With us. Yeah, keep it up, Brad. All right. Cool. Thank you, everyone, as always, for watching and listening. And I will put down links to all the stuff I mentioned here in the episode. And give it a like, give it a share, and hopefully you all got a lot out of this. Thanks, Larry.
It was fun. Thanks, everyone.
All right. Take care.